Stocks in play next week, capital flows, triggers, and the architect of power in Indian markets. Financial markets do not move because people are optimistic or pessimistic. They move because power shifts, liquidity migrates, liquidity migrates, and permission is granted or withdrawn. Every week, headlines attempt to dress this reality into softer language. Earning beats, order wins, partnerships, reforms. But beneath the noise lies a simpler truth. Markets are systems of control responding to pressure. The list of stocks in focus next week is not a list of opportunities, it is a diagnostic report. It tells us where stress has accumulated, where authority has intervened, where capital is no longer forced to react rather than freely allocate. To understand such a list properly, one must abandon the retail mindset of what should I buy and adopt an institutional question. Where is capital constraint and who benefits from that constraint? The market regime. Why context dominates content. Before a single stock is analyzed, the regime must be defined. Markets do not reward stock picking in hostile regimes. They reward survival, timing, and asymmetry. The current Indian market regime is defined by five facts. Pardon, is defined by five facts. Equity benchmarks are weak but not collapsing. The Sensex and Nifty closed the week lower but not in panic. This is not capitulation, it is controlled retreat. The rupee has touched a historic low against the dollar. Currency weakness isn't cosmetic, it is structural. It raises imports cost, pressures inflation, and compresses valuation multiples. When currency bleeds, equity lose strategic freedom. Foreign institutional investors are net sellers. FIIs do not sell because they hate a country. They sell because risk-adjusted returns elsewhere look superior. Their exits are not emotional. They are algorithmic and mandate-driven. Domestic institutional investors are buying not only defensively. Domestic money is stabilizing markets, not reversing trends. DII cushion declines. They do not create bull cycles in isolation. Volatility is persistent, not episodic. This is not a weak disturbance. This is a regime where sudden reversals, sharp intraday swings, and narrative whiplashes are normal. In such an environment, stock stories do not overpower microgravity, they merely react to it. Why stocks in focus exist at all? A stock appears in focus only for one reason: something external has disrupted its equilibrium. These disruptions fall in five categories: order, visibility and state-backed demand, policy signals, rates, regulations or government directives, operational normalization, recovery from chaos, regulatory shocks, especially in pharma and finance, currency exposure, direct or indirect. Each stock discussed next belongs to one or more of these categories. None are being rewarded for innovation or long-term vision. They are being watched because they are under pressure. Indigo. Stability as temporary currency. Indigo's presence in the list is not about growth, expansion, or dominance. It is restored operational stability. The airline, returning to operating over 2050 daily flights, reconnecting all operational destinations, is significant only because chaos preceded it. Markets punish uncertainty in airlines faster than in almost any other sector. When flights cancellations, schedule disruptions, and regulatory interventions appear, valuation collapses are swift. Indigo's recovery signals one thing: the bleeding has stopped for now. But stability isn't power. Stability buys time. It allows capital to re-enter cautiously, not confidently. Rising fuel cost, a weak rupee, and constant regulatory scrutiny ensures that airlines remain fragile institutions in volatile markets. Indigo is therefore not a growth narrative. It is a relief trade, useful for short-term positioning, irrelevant for long-term conviction unless macro conditions improve. Bharat Electronics (BEL), where state power meets capital. If Indigo represents fragility, Bharat Electronics represents institutional certainty. Defense companies operate under a different logic. Their revenues are not governed by consumer sentiments or export cycles, but by state priorities. Fresh orders worth hundreds of crores signal not merely business success but continued political and strategic alignment. In uncertain markets, capital gravitates towards these three things: visibility, sovereign backing, strategic relevance to consumer cycles. BEL offers all three. Defense spending doesn't disappear during volatility. It often intensifies. Geopolitical risks adds a premium that markets are reluctant to price out. As a result, BEL functions as a defensive growth asset, a rare combination in fragile regimes. This is why institutions accumulate defense stocks quietly, while retail chases noise elsewhere. Defense is not exciting, it is inevitable. KEC International Capex without romance. KEC International's order wins place it squarely in the infrastructure and transmission narrative. Infrastructure, however, is one of the most misunderstood sectors in the Indian markets. Capex stories do not fail because demand disappears. It fails because projects are delayed, cash cycles tighten, execution overruns consume margin. Transmission and power infrastructure are unavoidable for a growing economy, but are but unavoidable doesn't mean lucrative in the short term. KEC's presence in focus reflects confidence in the continuation of capex, not the acceleration of profitability. For serious capital, KEC is a medium-term accumulation candidate, not a momentum trade. It rewards patience, not excitement, and those who confuse order size with shareholder returns often learn this lesson very late. Wipro AI as an entry ticket, not a weapon. Wipro's expanded collaboration with Google Cloud and internal deployment of AI tools matter less for what it promises and more for what it prevents. In the current AI environment, AI, in the current IT environment, AI adoption is no longer a differentiator. It is the minimum requirement for relevance. Companies that fail to integrate AI internally risk being seen as unserious regardless of their marketing claims. Wipro's client zero approach, using AI internally before selling it, signals credibility, not dominance. It tells the market we are not obsolete. It doesn't say we are leaders. In a weak global tech spending environment, this distinction matters a lot. Wipro's AI moves stabilizes narrative risks but doesn't eliminate margin pressure or demand uncertainty. It is a defensive maneuver, not an offensive breakthrough. State Bank of India: Credit, Power and Hidden Cost. SBI lending rate cut is a classic example of policy signaling. Lower borrowing costs are meant to stimulate credit growth and support economic momentum. Markets often react positively, briefly, but banking is an art of delayed consequences. Rate cuts compress margins, growth increases risk, and historical loan write-offs running into several lakh crores remain a shadow behind every PSU bank balance sheet. SBI inclusion in focus reflects policy alignment, not balance sheet perfection. It is a reminder that banks sit at the intersection of political will and economic reality. Short-term sentiment may improve, but long-term valuation depends on asset quality, discipline, not announcements. Dr. Reddy Laboratories, where regulation overrides everything. Pharmaceutical markets are unforgiving when regulators appear. The US FDA Form 483, even with a small number of observations, immediately injects uncertainty. Timelines become unclear. Costs rise. Approval delays threaten pipeline. In pharma, growth stories pause. Regulatory stories destroy value instantly. This is why institutions avoid bravery in such moments. Capital doesn't fight regulators, it waits. Dr. Reddy's presence in focus is a warning signal, not an invitation. United Drilling Tools, the illusion of small headlines. A small export order can move a small cap stock, but it doesn't change its strategic position. Markets remain Markets mention such stock as because liquidity is thin, reactions are exaggerated. Professionals understand this dynamic and largely ignore it. Scale determines relevance, symbolism doesn't replace substance. United Drilling Tool is a reminder that visibility doesn't equal importance. What actually moves market this week? When all stock specific stories are stripped away, the real drivers remain currency collapse, foreign capital outflows, global rate expectations, trade negotiation optics. None of these are controlled by individual companies. They are defining feature of the current regime. Macro forces overpower micro excellence. Stocks are soldiers. Currency rates, capital flows are generals. How smart money interprets this leaves. Serious capital doesn't ask which of these should I buy. It asks where is the risk mispriced? Where is the capital forced to react? Where can asymmetry be engineered? The list becomes a watch list, not a shopping cart. It guides observations, hedging, and timing, not blind participation. Retail impatience often becomes professional profit. Final verdict: survival before supremacy. This is not a bull market environment, it is a discipline testing environment. The correct posture is capital preservation, trigger based positioning, regulatory caution, currency awareness. In such markets, brilliance is optional, survival is mandatory. The final truth is uncomfortable but necessary. In unstable markets, patience is power, and impatient funds professionals.